So you really want to put $100,000 in your pocket in your small business. Is it even possible? Well, guess what? Most of you right now are not even coming close to making $100,000 a year. The average, if you wanted to know, is somewhere between $35,000 and $55,000. But you want more. You work hard and you deserve to be able to make a lot of money. Hey, badass business owners, my name is Tammy and I'm here to help you on your journey to making $100,000 in your small business. So first thing that you have to do in order to start this quest is you really need to step back and understand that you make money two different ways. You wear two hats in your business. Hat number one is an employee in your business. Let's face it, for most of you, you're doing the vast majority of the work. You're the one that is going out there and either making the products that you sell or providing the service that you do, in which case you're really just labor. You're the employee. And a lot of times when you're taking money out of your business, you're like, oh, I'm taking this owner's money and this owner's drop. No, you're not. You're paying yourself, the employee, in your business. Where you make money as an owner is if the business is profitable. And the business is only profitable if you're capturing the employee cost of goods that you are spending for your particular business. And we'll talk more about that here in a second. So the first thing you need to do on your quest to get to this $100,000 is understanding that you get paid as an employee and then as a business owner, and only as the business owner if the business is successful. Because guess what? If you have a losing month, the person who's going to pay those bills is you, in which case you're paying yourself less as an employee. The next question that I get from people is, Tammy, well, what should I make as an employee? What is a fair wage? And that's important for you to understand. Just because you feel you're worth $50 an hour, if you were to go out and hire someone to do what it is that you do in your business, what would you pay them? For example, if you were going to pay someone $20 an hour to do what it is that you do in the business and they work 45 hours a week, you're going to have about $900 a week coming for employee wages, in which case then you would take that $900 each week out of the business for the employee time that you've done. So it's that $18.32 that you're going to make, or 36, 36, that you're going to make at the end of the month in the business as an employee. Then what's going to happen is you're going to get to the end of the month. You're going to say, okay, I brought in this much in sales. I paid this much out in cost of goods, including that employee money, which we'll talk about once again in a second. These are all my bills and my expenses. And oh my gosh, the business made $1,000. So out of this $1,000, you're going to pay your taxes. You're going to reinvest back in the business, and you might pull out maybe $300 as a business owner after you do all of those things. So now you've made this money as an employee in your business, and you've made this money as a business owner from the owner's draw after the profits of the business. But let's say you get to the end of the month and it's the opposite. You're a negative $1,000. Well, who's dipping into their pockets to pay those bills? It's the business owner. So while you made money as an employee, you turned around as the business owner, and now you have to come up with $1,000 to pay the bills. So the employee is always going to get paid. The business owner, you may get paid, or they may be dipping into their pockets to pay. And for a lot of you guys, that's where you go, wow, this kind of makes a little bit of sense, because you get to the end of the month and you seem to have less money than what you thought you had, especially after you've paid yourself. And that's why, because the business owner you is having to constantly reach in their pockets to make up. And if you have like a savings account or a checking account full of money, you've probably watched that go down. You'll put money in and then it drains, and each month it ends up less. That's where if you're looking at your business numbers and you're looking at your balance sheet, one of the things that they track on there is your checking account, savings account. And now you can start seeing where the business is lowering its assets and its money, because cash is assets. And it's because you're constantly having to put it back into the business. So it's important that you understand that. Now, here's the thing. Let's go back to this cost of goods thing, because I get a lot of questions on this. Is it cost of goods? Well, first thing you got to keep in mind, what is cost of goods? Cost of goods is any money that you spend to either create the products that you sell or to provide the service that you do. So if you make candles, then you have labor that has to make those candles, right? If you just buy a candle and turn around and sell a candle, there is no labor associated with that. But if you buy the wax and the wick and all that other good jazz and you make those candles, then there is labor. Somebody has to make those candles. So that labor would be cost of goods. If you just buy the product and turn around and resell, they're not a cost of goods. If I install water heaters or if I do landscaping or any other type of service-based business, it might take me an hour or two to provide that service. Therefore, I need labor hours to make sure that I'm priced correctly. We have other videos that talk about pricing, and we'll continue to do those coming up. But it's important to understand that if there's a labor hour needed to provide the service, you must count that as a cost of goods to be able to fully understand if you're pricing correctly and you're running your business correctly. So let's just say it takes you 2 hours to do something, then you have 2 labor hours that you need to capture. And if that fair wage is at $20, then that's going to be $40. So what's going to happen is your employee money, you're going to make sure that you're putting it under cost of goods if you do one of those two things. If you are making the product or you're providing the service, it's going to be a cost of goods. Now, here's one of the things I hear all the time. People go, well, my accountant says I need to put it here and this and that. Look, there's a difference between accounting and doing your taxes and putting it on your P&L. So this way, you know, you have a nice, clean P&L. At the end of the day, whether you take money as an employee or you take money as a business owner, all of that is going to get taxed. So honestly, it doesn't matter if it's after the profit side or if it's up in the cost of goods. But it is important to you for your bookkeeper to put it in the cost of goods so you can understand that what your true cost of goods are. Now, if you are just doing, answering the phone, doing the schedule, stuff like that, that is still an employee. If you would hire an employee to do that, that's still an employee thing. And in which case that would be more operational. So let's just say you buy the candles or you buy the trinkets and you turn around and you sell those, but you are still working in that business as an employee for say 20 hours a week doing employee work. Well, now it's not a cost of goods because you're not making that product, but what you're doing now is you're putting it under operational because you're doing employee time. So that $20 would be count there in that particular section. So it's important you understand that any employee time that you do, that you are capturing it in the right place on your P&L, because that's going to give you clean numbers, which is really the next step to getting you to that $100,000. But that's going to come up on a future video. I'm going to do a whole series on this to help with it. But for now, we want to just make sure that you're paying yourself correctly as part of your step to getting to that $100,000. So now we know you're getting paid as an employee, right? Up in the cost of goods, possibly in operations. And then only then, if the business is profitable, are you going to take money out as an owner's draw. And just to recap, any profitability that your business has to go to 3 things. You have to put money aside to pay your taxes. You do not want the tax man on your butt. The second thing you're going to do is say, hey, how much of this money has to be reinvested back into the business to pay for more future goods or a rainy day fund or to cover your employees, whatever it may be. Then, only then, after you've done those things, can you take money out as an owner's draw. So you would have taken money out, paid yourself weekly or monthly or however you do it as the employee in the business. And then once you determine if the business was profitable for the month, you can determine if you're going to take an owner's draw. This is why when you go to scale, it's important you know this. The reason is you can only work so many hours. There's only so much money you can make being an employee in your business. The money that really takes you from that $35,000, $55,000, $60,000 is when you shift from an employee to making the business profitable. The more business that you have, the more profitability that you have, believe it or not, that's where you're going to make the money. Because now, if the business is throwing off $50,000 in profit every single year, and you're going to get, let's just say, a third of that, now all of a sudden you're adding an additional $20,000, give or take, it's a little less than that, but you're adding an additional $20,000 to that employee money that you were making. And then as you scale and you either bring in other people or you reduce your hours working in the business, whatever the case may be, you want that profitability to go up because you're no longer getting that employee money. And that's why sometimes somebody will make 60 grand working in the business, then they start hiring people and all of a sudden they find they make less money. And the reason is because you did not capture your old employee money in your cost of goods. Now you've hired these employees who are sucking up that money that you never accounted for. And now you're not making any money because the business was never profitable because you never had good books and you didn't capture the money for you as an employee in the business. Hopefully this is all making sense. I do have another video that I'm going to put up here. Actually, I might have 2 that will help you understand this concept a little bit better. So if you are on your mission to get to that $100,000, join me over the next few weeks, hit subscribe, hit that like button, and we're going to keep talking about the things and actions you need to take for you to be able to get to earning $100,000 and putting it in your pocket in your business. And I'll talk to you next time. Bye for now.